Hi, everyone. Welcome back to the Retirement Cheat Code. I'm JD White, and today we're going to talk about how everything that you stash away for retirement gets taxed or not taxed. Thank you so much for watching. I hope that you learned something valuable from this video. Let's get into it. Everything that you put away for the future has tax consequences. So, the easiest way that we've talked about this with our clients is using what we call tax buckets. Tax buckets. So, we've got three tax buckets that we typically talk about. The first tax bucket is the one that you are probably most familiar with. It is the pre tax tax bucket. The pre tax bucket is your 401k or whatever retirement plan you have through your work, traditional IRAs, which most people just call IRAs. There's also SEP IRAs and simple IRAs. So there's a few different accounts that fall into this category. Basically, the way this works is that when you put money in, you do not pay taxes on it today. You are saying that I'm going to kick this can down the road and I'm going to pay taxes on it later. So you are deferring those taxes down the road. The idea here is that you're hopefully in a lower tax bracket when you retire. So if you are in a, say, 35% tax bracket today, the income that you're projecting to live on in retirement puts you in a 24% tax bracket. Then you want to defer that down the road with the idea of paying less taxes on that money later in life when you retire. It's also worth mentioning here that 100% of the money when you pull it out of those accounts gets taxed as income. You put $100,000 in, it's worth $100,000 when you pull it out. That $100,000 is all taxable income. And that's the only way it gets taxed unless you do some other stuff. So that's the first bucket. The second bucket that we like to talk about is probably the most neglected bucket of them all, and it is the taxable bucket. And this is not a retirement account. It is non-qualified investment accounts. So that stock that you bought on a hunch in your E-Trade account, that was probably in a taxable bucket. Your home is in a taxable bucket. Collectibles, anything like that is usually in a taxable bucket. So the way that the taxable bucket works is that you are using after tax money to make your initial purchase. That is, you are using money probably from your checking or savings account to buy whatever that thing is, whether it's an investment or your home or a collectible, something that we hope appreciates in value that we can utilize later in life, either for us or the next generation. The way that the taxes work on this as it moves down the road is that when you take that money out, you are going to pay what's called capital gains. And this applies to anything that we sell for more than what we purchased it for. You're going to pay a capital gains tax. Those rates are dependent on how much money you bring in, but they are typically more favorable than what we pay on income tax, which is great. There's long-term and short-term capital gains. Again, lessons for another day. That's kind of the theme here. But we're going to build on this stuff. And then along the way, a lot of the investments that we own are going to pay some taxes as we go in the form of dividends or interest payments from those things, or if we're collecting rent from a rental property, that all gets taxed as we go. When we're getting it on an investment, let's say you own a stock and those dividends reinvest, the cost basis is actually going up as we go. So when we sell it, we have more in the bucket that's not going to get taxed, which is a good thing. So we really like the taxable bucket. That is the second bucket. And our last bucket is our favorite bucket. It is the tax-free bucket. And the reason we like this is that you put the money in after taxes, just like the taxable bucket. So it's money that typically comes from your checking account or savings account after it's already gone through your payroll. And then you put it into a Roth account, whether that's a Roth IRA or there's Roth K in some 401k plans. That money now grows tax free as long as it's qualified. And then when you pull it out, it is still tax free, which is great. Now, there's a lot of rules around the Roth on how you can get the money in. There's rules on how you can get the money out, just like our pre-tax bucket. There's some rules around when you can take those withdrawals. Typically, we think of those as savings for retirement. So that's a big rule there. The growth in a Roth IRA or Roth account is totally tax free. We have a few strategies that we'll get into down the road about how to get money into the Roth IRA. But for today, I just want you to understand what it is and why we like it so much. Tax free growth, tax free money out is a really big deal. It's also worth knowing that these buckets work a little bit differently when we die. So I've got another video in our death and taxes playlist that talks about specifically how these accounts get taxed when we pass away and how they ultimately get taxed to our beneficiaries, our heirs, whoever you leave your money to, how these buckets get taxed differently to them as well. So check that out. And if you enjoyed this video, or if you just learned one thing, even if it's that I painted this, click that thumbs up button. Really helps me know whether or not you like these videos. If you want to keep hanging out with me on this journey, click that subscribe button to make sure you don't miss future videos. I really appreciate your time, and we'll see you on the next one.